Well, very little has changed, ladies and gentlemen, this week. We closed at 30, which gives us a position in the models which is very, very close to a risk on the daily minus 0.88. So we could, if things stay unchanged, have a daily buy on Monday or Tuesday. And in the weekly, we are at minus 0.91, which definitely gives us a buy on Friday if it stays unchanged. But I've had a look at all the spreads, and the likelihood of us going into the green area or strongly green over the course of the next 1 or 2 weeks is very low. We are still basically going up and down within this yellow area. We need a thrust to go into the green, and from what I can see from the position of the spreads, we are unlikely to have that in the next week or so. As far as deviations, absolutely no change. This middle line, which is now turning up, is the equivalent of 29.52, and that is really going to be the bull bear line: underneath bad, above good. But you can see really the odds of us being able to break the 30-30, 30-40 area and go higher are very low. We need several closes at this level to start opening up the Bollinger Bands. It's unlikely to happen in the next couple of weeks, I think. So a range and possibility of a break is actually higher than many people would think. I've had a look at the sectors. I won't bore you with it, but there's nothing really exciting going on. To me, this is still a low volatility environment with the possibility for bad surprises in the US being higher than the possibility for good surprises. And really, fundamentally, the Blue Angels are telling us all we need to know. This 17 times line is very unlikely to be broken in any hurry. So we have our upside given by deviations and by the Blue Angels. Any bad surprise and we go straight down to the time 16 through that 29.52 and gives us 28.25. So that is why I keep on saying in the US the probability of bad surprises to me is up here higher than the possibility of breaking the time 17 line. What's going on in the bonds? Well, to me this 172 level is going to be very important. That is basically what the market has done is gone back to neutral. It's taken out most of the probability of a Fed cut this month, but still the probability of one in December is very elevated, and I think quite rightly. 50-50 whether we get one this month, I doubt it, but we certainly get one in December, and really the 2-year is going to be closer to 150 by the time December comes. That is why I'm not really an enthusiast of buying it here, because it's just not good enough risk reward. I'd much rather see this 172 level to put on a position. The fives are doing, repeating this pattern here. Exactly. If we by any chance see 177 and some sort of a disappointment that the Fed didn't cut and stuff like that, again, position time. It's unlikely to go through there in a hurry, and certainly the likelihood that it falls down towards this 116 level at some stage is higher than the likelihood that it breaks 177 and stays above there. There is absolutely no chance that the Fed changes policy. To me, this 177 level is going to be very, very significant, and certainly a position that I want to have long positions in the 5-year. I'm not even going to show you the 10-year and the TLT, because to me the play is for a steeper yield curve, so there's not even any point in looking at it. In bunds, I think we're very close to the top. Okay, I mean this was a very nice doji candle. I think this is the range where you put on a position for a return to around the minus 50 area at least. So minus 32 to minus 40 is the area where basically you want to get it as close as possible to minus 32 and get some cool spreads in the Bund. I think minus 50 at some stage when the ECB starts heavily buying is the risk reward here. I know there is a lot of talk about Germany reflating and stuff like that, but I just don't see a change of policy coming immediately. And they've pre-announced this QE, which is going to go on forever. There aren't any 10-year bunds. The Germans aren't going to issue any. Of course, the situation would change if they told you that they're going to start issuing boatloads and trying to reflate the economy through fiscal means. But I think we are a long way away from that. I think this level here is a very good risk reward for a move back down to minus 50. The Bund 10-year note spread keeps on testing this 210 level and it can't break. That is why I still can't get bearish of DXY. Excuse me. But the next reaction up is going to be very interesting. If we can't hold the higher levels, even with this spread where it is, and it should now start backing off back towards this kind of level, 230. If we can't stay up in DXY, then there's something very interesting going on, very strange going on. And I'll show you that next. But the situation in DXY could be changing, and that could have a profound impact on where people are allocating their risk capital. As I said last week, really, if we break 111.08, we're going to go straight up to the 200-day moving average, almost achieved. I'm prepared to think that this is a consequence of the sterling strength, and you just can't keep the euro going south when sterling rallies 7% in 2 weeks. So I'm still prepared to accept that this is an anomaly, and that we will go straight back down below this 110.60 and of course 111.08. But I think the price action when we get here is going to be very interesting. If it can't go any lower, I think the whole dollar complex might be turning. I know it's probably premature, but that is what I'm sensing, that it's just not trading right. There is something bigger going on, and I think that something bigger is that people are slowly rotating out of US equities and dumping US dollars. The pound has done its beautiful move. It got very close to this 138 level, just above 130.50. It's tired, isn't it? I mean, this is a lot to digest in 2 weeks. We probably need to come back to below 128, around this 127 area. It right about here, 127 something, or even here, yeah, exactly 127. That is going to be a great level. I mean, you still need to be long of calls and call spreads. There is absolutely no way that this is all there is to the pound and it's going to come straight back down. Fundamentally, the Brexit deal will get done. Whether it takes a week, 2 weeks, whatever, it really is irrelevant to me. I'm a buyer of sterling on all pullbacks. I think this pullback next week is going to give us the DXY levels that I showed you, And after that, I think that sterling leads up towards the 134 level. That is what I think. I'm gonna be buying cable and euro. Yes, euro GBP on all dips and euro and spikes in euro GBP. In DXY, the situation actually is very, very clear. We have a sort of 9650 level here, which is such an important swing level. I think the odds of breaking it now are very low. That's why I'm still long of DXY here. I think we definitely at some stage get a reaction up to at least 97.87 and possibly to these levels here at 98.30. But what we do here is going to be tremendously significant, because if all this is a correction up here and we can't sustain these levels, I think this time into the fourth quarter, it tends to be more volatile into December. We will break the 200-day moving average and we will start trading significantly below the 96.50 level. And when we do that, it's going to be a massacre because everyone's long. I think there is a reasonable possibility that this is being driven by long-term asset allocation to the US, and that people are finally beginning to dump US equities in favor of all sorts of other equities. To me, the situation in gold is absolutely unchanged. If I am right and the dollar is now at some stage going to weaken after rallying some, it's time to really buy volatility in gold at 1467. While it cannot get below there, to me the situation is still bullish, and you could get yet another move quite a bit higher towards the 1700 area. I'm not a seller of gold, or I'm a trader of gold. At the moment, the bonds are not giving me the confidence that I need to sell gold, and the dollar is telling me to be very, very careful shorting gold. So, I'm going to take my clue from the market. 1467 seems to be the level that the risk reward says belong, or have some call spreads. As simple as that, really. You don't really need to think about it too hard. Very much the same situation in silver. I'm not going to think about it very hard at all. 1664 to 1620 is where I get long of call spreads, and then we see. Really as simple as that, because if I'm changing my view on the dollar, then I have to be bullish, both silver and gold, and other metals and stuff like that, especially because equities are just not going down, which tells me that there is a decent possibility that we get a growth spurt in Q1 of next year, and that should make the whole of the commodity sector go up. What is going on in US equities? Well, this is the interesting thing. Nothing is going on in US equities. Now, you would have thought that when other equity markets are doing well, it was always the case that the S&P would do even better. Now, those spread relationships seem to have reversed, and it does make sense because the long-term uncertainty in the US is what happens in late 2020. I don't think the US is on the border of a recession. I think the Fed is easing. But I think as I've been telling you, the US is caught between all these cross currents. The bonds, the yields, the valuations, the multiples. I think people are slowly rotating out of the US. I think they're taking the opportunity on every spike up
to basically sell the US and reinvest the money not out of the equity sector, just into different equities. If you have a look at what people are in general, and I'm talking about the big money, they are still positioned relatively defensively in the equity sector. And if you're going to have a defensive position in equities, well, you might as well have one in somewhere that yields you something. Like German equities are defensive, but they're much, much cheaper. Certain Japanese equities are defensive, and they are much, much cheaper than the US ones. Why have the most expensive defensive sector in the world? Doesn't make any sense if you're defensive. So that could be what is going on, and I think it probably is. And the fact that there is complete lack of impulsion from NQ, which should be the leading sector in the US. So I don't know what to tell you. I think the 30-30, 29-50, 29-40 is really what you're going to keep on seeing for the next foreseeable future. If you have a look at the weeklies, basically, 29.52, below that we are, getting into trouble, and I think we trade straight down to 28.64. So very, very important level. But I think the upside is almost nothing. And that is the problem with the US. Why play it? Really, I'd much rather, buy it down here or buy volatility here than anything else. To me, leave it alone. To me, the technical position of Europe is actually a lot better than in the States. We have, on a closing basis, cleared the previous high that we had here in July. We are coming to the end of Brexit uncertainty. Everyone is short or not long the European sector simply because everyone was shouting recession. It won't go down. We have very good support on any dip. I think we see any dip down towards this 12,100 level. It's time to ship it in, because I think it'll end the year somewhere around 13,500. It seems impervious to bad news. To me, the DAX is a much better buy on dips than is ES, and so is Nikkei. Just a much better buy. Just technically, it looks a lot better. I think maybe a bit of backing and filling, but eventually, within a couple of weeks, I fully expect this 23,300 level to trade. So 23,300 is where I'm looking for it to be within a couple of weeks. While ES, it's still going to be very much where it is now. But the real joker in the pack is this one, EM. I think, without a shadow of a doubt, I mean, of course I've got lots of doubts, but I've bought quite a few call spreads last week. I think 45.04 trades before year end, and that is a big move. I mean, that's 10%. So okay, it's not 10, it's 8. So that is, to me, this is a very, very, very important level, 45.04. I think we will reach it within a month. To me, it's even if we now only stabilize in the dollar, which I think is more than likely, people are going to shift their allocations towards EM. I think it's very much worth buying because the technical position is a lot better than in the States, and you will know when you're wrong. I mean, it's as simple as that. If it starts pushing below 40, you just dump your call spreads and that's it. Very good risk reward to me. Volatility has been excellent really in predicting the ES moves. To me, at the moment, it's saying it's going nowhere. again, is going nowhere fast. I don't think it trades much above 16, and I don't think it trades anywhere lower than about this level, 12, 12.20. Let's call it 12, who cares? So that to me says that above 3030, no legs, and really a very little chance of breaking the 2952 in any kind of impulsion. Will it trade 2940 intraday? Probably, but it's unlikely to close below 2952 and give any impulsion to the downside in the market. That's what volatility is telling me, and therefore any dip, and there will be dips, I'm absolutely sure, in ES. When that dip gets to that 2950 area, it and has really dragged down EEM and DAX and Nikkei, that is the time to buy those, as opposed to do very much at all in ES. Well, very little change in the biases. Certainly not for the bonds. Absolutely nothing's changed in bond land. The bonds have slightly refined. Minus 32 is what I'm hoping for, but I'm starting to nibble. Okay, it's as simple as that. I think the true range is this, minus 40, minus 63. Will there be pushes to minus 32, maybe even minus 26? Possibly, but who cares? Above minus 26, we see a reversal. And that would actually have a lot of implications for the US dollar. But we're not there yet. Why discuss it? SPX and NQ, I mean, I'm so bored by them. I think you just leave them alone. You just have these huge swing levels, and it keeps on going up and down, and everything basically closes where you open the week. A few pushes above, a few pushes below. Volatility says 12%. It's just going to stay around here. That's why you really need to concentrate on other equities. I showed you EEM, and that level where I think it's going to go this year, and I've showed you the DAX, and I've shown you the Nikkei. When ES dips and it drags them down, that's the time to buy them. But this is the change. This is the stuff that's going on. Could it be because of sterling? Yes, it could, but I'm beginning to change my mind. I think this is going to be very interesting. When DXY gets to this level, I think it's going to rally next week at some stage, but when it gets to that level, what it does is going to be the tell. If it can't hold those levels, then I think the likelihood of a dollar reversal into year end really does increase. Thank you very much indeed, and tweet you on Monday.